Welcome back to the Week in Markets. My name's George Bell, joined today by Matt Henderson. Quite a lot going on this week, but in terms of some of the key takeaways, we've seen some real strength actually across global equity markets, particularly areas like the US and the emerging markets. Bonds have also provided a positive return as well. We've seen the price rise as bond yields have actually came down, and we've seen the dollar, which has weakened. So the pound has strengthened relative to the dollar. Dollar's down about 2% on the course of the week. So dollar's actually back to levels we haven't seen since early 2022 now.
Yeah,
and
just before the inflation shock and the rise in central bank hikes that we've seen. So
exactly. So quite a lot of discussions really have been around dollar strength, but we're actually back at those sort of pre-inflation levels, and some fairly sizable swings in the oil market as well.
Yeah.
So it's maybe not a bad place to start actually. What impact is conflict having on the market?
Yeah, so I guess what we saw pre-conflict, where the oil price was, we're probably talking $60 or below, in that range. But then as we saw the conflict pick up in the Middle East, actually that's obviously a large producer of oil in the globe. So as we saw oil prices rise as conflict increased, so the oil price got up to about $75. But I guess this week what we've seen is a bit of a pullback, or a bit of a cooling intentions in the Middle East. So actually the oil price has followed that. So that's moved down to about $65 per barrel. And I guess really what the main takeaway that we're taking away as investors is that's probably going to be GDP positive, because essentially higher oil is just kind of like a tax on the consumer. It means they don't have more disposable income to spend on going out or buying goods that they would like to. And it's also likely to be positive in terms of inflation. So it's it's likely to keep inflation lower rather than it pushing higher.
So it just eases some of those pressures.
Yeah.
And I think gold has been a useful tool through the course of this year when we have seen elevated conflict and also elevated concerns of what this all means for inflation. But the gold price, just as some of those pressures have eased, has just cooled back through the course of this week.
Quite a lot of the investors we speak to, and some of our own thoughts as well, is that gold's quite a useful tool in terms of geopolitical risk.
Yeah.
So as those tensions have just dropped, it's just meant that maybe gold prices have cooled a little as investors have just looked to pivot elsewhere in the portfolio, like you've mentioned with some of the stronger equity returns that we've seen.
Yeah, so you've had stronger stock markets, you've had positive returns out of the bond market, dollar's weaker, oil prices are down, gold prices have cooled at the margin. So what is it the market's focusing on? Is it trade? Is it inflation? What are the key aspects?
Yeah, so they're the two main things that's forefront of the market's mind at the minute: trade and inflation. I guess if we think of it through different assets as well, equities maybe a little bit more focused on the trade side of things. Bonds, they're also partially looking at trade, but more thinking about what would trade do to the inflation prints that we might see going forward.
Yeah, and in terms of trade, we've had a number of developments from the US side mainly. What are the key takeaways?
Yeah, so I guess what's important to remember is that US put on those tariffs, and what they agreed to do was have a 90-day kind of grace period where they would look to take those tariffs down.
Just 1 week after they put them on as well.
Yes, so the situation's been evolving very, very quickly. So they said, look, we'll have 90 days, we'll look to negotiate with people, we'll take you down to a 10% rate, which is still pretty high from a starting point of zero, but where some of the US tariffs had got to with China of 200% plus, the market's seen that as a positive. So as you said, since only a week after those were put on, markets sold off. Markets are up 16% since that announcement. So it just shows how fluid the situation has actually been. I guess the big update that we've got is that this 90-day period's coming to an end. So 9th of July is when it was due to expire. So we'd have seen those rates ratchet all the way back up. But what we've seen is that the US have confirmed that they're pretty close to signing an agreement with China. I guess what's also important is that China have also acknowledged that point and said, yeah, we are close to reaching an agreement with the US. So that would see tariffs from US imports into China, but then also China imports into the US, those tariff rates knocked down. And I guess what the US have also got out of this deal is access to some of the rare earth materials that China has. So they're used in things like building computers, laptops, PCs, semiconductors, etc. So that's one of the things that the US has been looking to secure, and it's managed to get that in this trade deal with China.
and 10 other countries who they're in discussions with at the moment. India expected to be one of the main ones.
Yeah, so that was the other thing that the US went on to say, look, we've got another 10 trade deals lined up as well, which would also see tariff rates fall. And you never know, we might see more things like that rare earth agreement made, or some other sort of agreement where the US, or Donald Trump really just wants to go back with some sort of a win, doesn't he? So he might be looking to secure those type of agreements within taking the tariff rates down.
Yeah, so heading in the right direction. It's progressive for growth and inflation. And we mentioned equities, and one of the areas which the stock market is really focused on is what all this means for corporate earnings.
Yeah.
And we've seen corporate earnings being revised down for this year in the US. So they were at a very high level at the start of the year, expecting corporate profits to grow by about 15% in aggregate, and that's been moderated down to around 9%. So there's quite a lot being priced in terms of concerns of what this all means in terms of supply disruption, increased costs. But any key comments there on earnings?
Well, I guess what we have seen from the markets is, despite 2025's earning rate falling, as you said, from 15 down to 9, what equity markets are actually able to do is say, actually, we're long-term investors. It's not like 2025 is the year where we make all of our money. There's 26, 27, 28, etc. So equity markets are able to look out into the future and actually look past this. So I think the view from the market is that these trade tariffs or issues will be resolved in the long run, and that these companies can continue being or return to the levels of profitability that they have seen, which I guess is reflective in the fact that since those tariffs have been announced, that the markets are up 16%.
And that's similar to us as investors. We take a long-term view, and one of the key themes that is emerging is that we are in an environment of disinflation, which is positive economic growth and cooling inflation rates, which is actually very positive for the stock market and also from certain areas of the fixed income market, which is what we're seeing. What about inflation? We mentioned it a few times today, but just this afternoon we've had an update from the US on what's the Fed's preferred measure, being the personal consumption expenditure measure. What was that telling us?
Yeah, so that measure came out, literally half an hour before us filming this. It's about in line with what the market expected, 0.1 higher, but there or thereabouts with market expectations. I guess the only real thing that we can take out of that data is we've seen a slight cooling in personal spending from the US consumer. So that was down 0.1. If you adjust it for inflation, down 0.3. But I guess that is what we would probably expect with some of the consumer sentiment readings that we've been seeing, and the fact that tariffs have been ongoing. We would expect that to have some sort of impact on the consumer. So it's not, it's not unexpected that we've seen that fall. I guess, given that we have seen a bit of a trade resolution agreed to, we could actually see those numbers move back positive in the next couple of readings that come through.
Yeah, so consumers have just reined in a little bit,
yes,
and that's had an impact on these numbers. Well, thank you very much, Matt. Quite a lot of ground we covered there. Hope you found it useful, and please do tune in next week.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.